Today's Money Metals Minute brought to you by MoneyMetals.com. 2 trading days in. It's still way too early to draw any conclusions about what the rest of the month has in store for metals markets, but seasonal factors tend to add upside pressure to the gold market in September. In fact, since 1975, it's produced bigger average monthly gains for gold than any other month. January comes in second. October tends to be third. Meanwhile, odds still favor the Fed punting on interest rate hikes until at least December. Earlier this year, officials had indicated they would raise rates multiple times in 2016, but then the lackluster economic data and the persistence of negative interest rates abroad came into play. The fact that the Fed's benchmark funds rate is now just a quarter point over zero means if a recession were to hit, the Fed would have few options for stimulus other than to go negative on rates, something that is being actively discussed as an actual possibility. Now here is a special report from Mike Gleason of Money Metals Exchange.
It is my privilege now to be joined by Michael Pento, president and founder of Pento Portfolio Strategies and author of the book, The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. Michael is a money manager who ascribes to the Austrian School of Economics and has been a regular guest on CNBC, Bloomberg, and Fox Business News, among others. Gold is up about 25% for the year. Silver's up about 40%. But both metals have come under pressure here over the last couple of weeks. And the mining stocks, which have been on absolute tear, have pulled back as well. So do you expect this to be a prolonged correction in the metals with prices maybe headed lower into September or October? What are your thoughts there in the metals?
Well, let's give you the reason. First of all, I am not a Pollyanna about any asset class. So if I thought that the Federal Reserve was going to be able to engage in a protracted, steady increase in the Fed funds rate in the manner they did between 2004 and 2006, if I thought that they were going to be able to do this in the context of steadily increasing GDP growth, then I would tell you, you better get the hell out of gold and gold mining shares as quickly as possible. I can tell you right now, I don't believe that's the case. So the pullback I see right now is healthy in nature. It's way overdue. And it was caused by a plethora of talking heads from the FOMC, Federal Open Market Committee, coming out, and it was perfectly timed up until this Jackson Hole meeting, which is going to occur on Friday, to tell Wall Street that they are way too quiescent in their view that the Fed is not going to raise interest rates in 2016. They haven't done so yet. They did once, as you know, in December of 2015. The market fell apart, and they threatened 4 rate hikes this year, and we are now coming up into September and have no rate increases so far. I believe they may raise once in December after the election. That depends if the economic data turns around. If you look at what's happened with GDP, if you look at Q4 GDP 2015, Q1 and Q2, we are now displaying 0 handles on gross domestic product. And if you look at the latest data on housing, existing home sales, which is by far the much bigger portion of home sales vis-a-vis new home sales, and if you look at mortgage applications are now down year over year, and existing home sales are down year over year. That says that the all-important housing market is rolling over. People cannot afford home prices. And I think after that brief blip up in data that you see in July, Q3 will also be very anemic, and the data between now and the end of the year will most likely not allow the Fed to raise interest rates between now and the end of the year. But even if they go once in December, the most salient point I can make to your investors is that the central bank will be very clear that this is not part of a protracted, elongated rate hiking campaign. In other words, they're going to go very, very, very slowly, as they've evidenced so far. And the terminal point, which they call the neutral Fed funds rate, will be much slower than at any other time in the past. So you think about in history, neutral Fed funds rates are usually 5 to 6% on the overnight lending rate. They're at 3. That's their target right now. And I believe after these next few meetings in September and December, Janet Yellen will come out and tell you that the terminal rate, the neutral target rate, is something in the neighborhood of 2%. So they'll be lower for longer and have a much lower terminal rate. And by the way, I don't think they ever get there. As I said before, I think the economic data turns profoundly negative between one or two more rate hikes. We enter into an inverted yield curve. We enter into a fully manifested recession, and that means the Fed joins the ECB and BOJ back into quantitative easing. Donald Trump is on record saying that he's the king of debt and that he loves debt. He is also on record saying that if the U.S. ever enters into another 2008 type scenario, that we can default upon that debt. Now, if you ever wanted to have another reason to own gold instead of treasuries that yield almost nothing, is the fact that the nominal yield you're getting, which is practically zero, even that nominal yield has been threatened to be defaulted upon. So while Trump is a deficit lover, so is Clinton, who I believe will, by the way, unfortunately, win the election. So I believe both of these candidates are lovers of debt. Both of these candidates will be vastly increasing to the amount of debt and deficits that we run up, which, by the way, will be and must be monetized, and according to Mr. Trump, will be defaulted upon. At least he's being honest.
Now, that was Michael Pento with some views, and Mike Gleason at moneymetals.com. The live prices right now at moneymetals.com show gold currently trading at $1,313.80 per ounce on the market. Silver comes in at $18.89.